What is going on, everybody, and welcome to another weekly update. And what I'd like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. If that sounds like something you're interested in, consider subscribing, as I do also provide essentially a weekly charts analysis as well. I do provide the technicals. So remember to subscribe and go ahead and like this video before we get started. And if you also want to follow me on X at Hemi137, I do give a pulse of the market there as well, as the market is quite dynamic and can change on a day-to-day basis. But that's again why we have this video, to at least try to prepare us for what could potentially be coming. So, as we always do, we like to jump into some weekly recap and kind of uh, encapsulate what we've currently gone through over the past week and how that can be interpreted for the next couple weeks to come. Again, I don't like to project too far ahead. I think if you project too far ahead, you'll be left holding the bag majority of the time. So, what we want to do is just make sure we're aware of the next couple weeks, watch our zones, and then technically go from there. So, past week, we've had a very big week, and we're going to be getting into a very quiet week, in my opinion, as we are leading up to essentially the new earnings cycle, which will be ending here in about 2 weeks. And then we will start kicking off some new earnings, which will get a lot more news, we'll get a lot more information. But not to diminish what has had gone on over the past week, even though the market didn't move much, we still got a lot of information. Now, over the past week, we did start out with core CPI that came in at 3.3 versus 3.4. Again, looking at the individual items, a lot of the individual items have come down a little bit. Services, car maintenance being a big one of them, was sticking at 22% for a long time. That has dropped to 20%. And then a lot of the other individual services have dropped slightly, but are still very, very elevated. And something I've been talking about on my weekly pulses is essentially that what's been going on is they've been uh, taking out a lot of the very inflationary items to bring down essentially the core where it's currently at. Ultimately, understand is still very high. They're only going year over year. The report has been diminished down to year over year. They are heavily manipulating this report to come in lower than actually anticipated. And even when we went up to 9% about a year and a half ago, we were much higher than that, but again, it's been manipulated. We're not taking the average of the last 5 years, because that would give us a true understanding before the pandemic where inflation is truly at. And again, the fact that we are really just slicing and dicing inflation into multiple different pies to make it look pretty. Again, you have to understand how inflation works. Inflation is on obviously on very high demand items, and especially when people are hurting in bad condition economic wise, financial wise, they tend to steer to a lot cheaper products. And a lot of those cheaper products have very high inflation on them, but those are removed from the report. Again, we've seen this. A lot of the upper class and the 1% are shopping at Walmart to save money. And so, with that being said, this is why you're seeing a big hit in like Target and many other stores. You're essentially Starbucks and everything else, is because people just don't have that excess cash like they did a couple of years ago. With the past decade, we've had a lot of free money cash flow floating around because of essentially what happened in the great financial crisis, right? It took a decade for us to come out of that. And then you notice over the last 3 years, when we were printed all 40% of the money supply, money was just coming out of everywhere, and everything was fine and dandy at that point, and essentially interest rates were at zero. And then this is what happens: you have high inflation, and you got to get through a couple of years of some really high inflation, and price correction is a big one of them, as a lot of uh, vehicles, a lot of homes have essentially almost 3 to 4x what they were just 2 3 years ago. And so all those need to correct. They need to get down to affordable prices, because people just can't afford them. If they can't pay cash for them, they're just waiting, and they're not buying new vehicles. They're just continuing to maintain, again, their current vehicle, which is why you're seeing high maintenance costs on that side of everything. So With that being said, again, core is, I guess you can say, slowly dripping off, but it's still very, very elevated. So the market didn't really celebrate. It wasn't too excited. It was good that it's not going up. And that's the way you can take how inflation is going on right now. Again, it's still very much unchanged. If you put everything back in, we're still sitting at with that 3.5 range, more than likely with 3.6. That's not even true inflation, which probably is much higher than that, sitting around 4. But again, you're not going to truly know the answer. Again, it all will be revised years after the fact. But with that being said, we do have the interest rate decision. Again, it came in unchanged. That was what was expected. We weren't expecting anything to change. The dot plot did come out on this last interest rate decision. So essentially, the 3 to 4 rate cuts that were that Powell was talking about in December are essentially diminished down to just one from what the dot plot is saying. So being said, we had Chairman Powell fall up with that, and again, he was very standoffish. A lot of his mannerisms, he's deep gulping and everything else to try to essentially get through because he is nervous. The fact that he knows more information that essentially the public is entitled to see, even though they're supposed to be quote unquote transparent. That is not the case. He even mentioned the fact that essentially the non-farms payroll that had came out was pencil whipped. He thought that there may be something extra there going on that is not really true. So even Powell mentioned that. I talked about that in my last video, is that Bloomberg had already called out about the numbers as well. You also have some other people, some other news media outlets that are talking about essentially inflation. It's not taken into account as well over the past 5 years, as opposed to the year over year, because year over year you're going to see not a big of percentage move as you would if you took on average of 5 years. Which took into account all the inflation ran up over the last 3 to 4 years, as opposed to a year over year. Year over year, you look a lot better. So again, a lot of manipulation happening there. Powell danced around a lot of questions. Obviously, they're not going to know, but the way he worded everything, he is trying to essentially pave the way to kick this can into next year. That is what they want. That's what they will try to do. But again, it is highly dependent on how things play out. If things start breaking, he's not going to have anything but a choice to emergency rate cut. And I've already talked about this. It will be a reactionary move. It will not be scheduled. And if it is scheduled, it'll more likely just be for a political gain because they're concerned about inflation running back up as soon as they cut. And again, if everything was fine and dandy, why would they not cut now? But there's concern about inflation. If you're pencil whipping inflation, then there would be concern there that if you start cutting rates, that things would be really bad. It could be stagflation, as again, if these job numbers are heavily manipulated, we could be higher. Again, they're saying we're like a 3.9. So maybe we're a little bit higher into the 4s. If that's the case, we don't really know because again, we're not getting clear data. So being said, with all that being said, those are some big data points on what to be looking for coming forward. So ultimately, as of right now, we're focused on the next earnings cycle. We're focused on what banks will go under, what more businesses will we lose, how much more bankruptcies will be filed is what we're watching. And we're watching for an event. And I've talked about this months ago, over the past couple months. And something we need to be continued and watch is headline news and what happens in the actions of the Fed, because once whatever this event is going to be, they will start cutting rates. The biggest thing to watch is how many rate cuts are they going to price in? What is that percentage going to be? If they essentially cut by multiples, then there's high concern. And this is where a lot of people have been waiting on the bond play for this to occur. And it's a very hard timing because you have to have massive momentum to be able to get that bond move that people are looking for. And so again, ultimately understand that what's going to have to happen is it has to be a big event, and Powell's going to have to cut by more than just 25 points. 25-point basis move isn't going to do anything. If he cuts by 50 or a full 100 points, then you're really talking about there's high concern there. And so this is what we're watching for. And so that's essentially what we've gotten out of this, is that, again, they're going to continue to kick this can until next year, if possible. And then essentially unloosen the belt next March when there's a new or there's a the election has been over, and then from that point, whether it's a new president or not, um, at that point, then they can loosen the belt and the market would crash then, and then they can blame whoever that president is for the crash. So just keep that in mind. So being said, and understanding that they got rid of the debt ceiling, they got rid of all these things so they could keep the market up. There's all these things are done strategically to essentially keep this thing afloat until after the election. You don't want things going into the election if you can avoid it. It's not saying it can't be unavoidable because it's happened during election years, but that's what they attempt to try to do. So we'll see how that does play out. That being said, a 50-year contract has come to an abrupt end. So that essentially has put an abrupt end to the petrodollar, which has essentially given us the power of the dollar, and understand that things had to be traded in the dollar over the past 50 years. That has since ceased because we were providing protection. But guess what? Now, guess who's providing the protection now is Russia. Yep, that's right. So the BRICS nations, they've been trying very hard to trying to loosen the grip of the United States. It's not saying it's not going to be easy. It's just another step in the direction, essentially, of de-dollarization, and understand that a lot of people have been selling the dollar because of what was coming, and now that they haven't essentially agreed to terms and try to extend essentially the petrodollar, we are in trouble. And understand that we're going to have to see how things will play out. Again, to look and see what we can trade is very minimal from what the rest of the world has. But again, we still have protection. That's one of our biggest things is military protection. And who can we find that needs military protection, right? And that's ultimately what essentially our big checkmate was. And if we don't really have that, we don't really have much to trade with. And so you have to keep that in mind. So with that being said, again, something that's going to take time, but be aware that it is occurring. There's steps in place. You need to be aware of what's going on in the globe because the world economy is changing rapidly, and we are losing our grip on essentially the global currency. And it's slowly slipping out of our hands. It's something that's going to happen overnight, but it is occurring, especially over the past couple years. And this event this week really is kind of solidifying that. So you need to keep that in mind. So some potentially even more positive news here. If your Tesla shareholder meeting was this week, something I've been talking about and why I bring up Tesla all the time, I think is one of the most innovative companies out there. They do a lot of things in-house. It's not just an EV company that like Wall Street likes to place it in. Even Tesla said this, or Elon said this multiple times, is that it is a technology company. And with FSD on the roll, he essentially said it could be potentially a $10 trillion market cap, and that humanoids can be a $25 trillion market cap. Now, again, the timing of all this will take time, but you have to understand the way the market works. Look at NVIDIA. Yes, AI will change the game, but is it doing a lot right now? No, it is not doing a lot right now. In the future, it will. Even all the multiple quote unquote sales that it has, you have to understand that it's still, it hasn't met that expectation yet. And so these are things you have to understand is that the market will start pricing in, I believe, over the next year or two for FSD, over the next year for FSD. And then humanoids, I think, will quickly back that in the next about year, 2 years. Kathy Woods came out with projections saying that it could run anywhere from $2,000 to the lowest bear case, essentially to the highest bull case, which is about $15,000 a share, which if you take into account humanoids is huge, and the possibilities are mind-boggling what could potentially happen there, especially selling these humanoids at 10 to 20K a pop. And understand there's going to be a 1-for-1 ratio. So every human there should be at least a robot. Understand that that being the case, how much that's going to make for Tesla, because you have to understand Tesla is ahead in that game far vastly before anybody else, because they've solved the energy issue or very close to solving that. And the biggest one is mass production. A lot of these startups, sure, you can put pieces together, but to mass produce that, you have to have the right equipment. And Tesla is, again, leaps and bounds in front of everybody else, like they were with the EV sector. So just keep that in mind. So there was some interesting news there if you are into Tesla. But aside from that, this next week, we don't really got anything. There's a lot of data coming out. I really don't care about that. I don't think it's going to be impactful. There is a lot of Fed members. There's starting to be more Fed members talking again now that monetary policy has come out. So again, there's nothing major planned until we start really rolling back into the new earnings cycle, which has been about 2 weeks out. It's normally a pretty quiet time period between then. We've got a lot of new headline news, and that is something you don't typically see. So your test for headline news will be the next 2 weeks. If there's a lot of headline news that's concerning because of the fact that you're going into earnings cycle, which they tend to try to hold some of that stuff in until earnings cycle to again flood the news cycles with tons of information. So hopefully something will be scooted under the rug when that happens. Also, this past week, we did have a lot of GME news. Roaring Kitty posted that he did execute some of his call contracts as well. They postponed their shareholder meeting because of that. So Roaring Kitty executed some calls and is now, I think he holds $9 million shares or something like that, something crazy of GME. So that was quite crazy as well over the past week. Now, upcoming events, monetary policy. Our next one isn't until July 31st. So next core is until July 11th. So that's July 11th is more around like the heart of when we start really kicking off earnings next month. So do keep that in mind. July 1st. So it's coming right around the corner. As you can see, the expected moves have drawn way back. We had a bigger week. So we were up in the 70s this past week. We're back down to the 60s. We're getting more into the average of not really expecting a lot. So do keep that in mind. And then, that's pretty much it. So this next coming week, again, we're really I'm expecting the market to start chopping sideways, potentially even start pushing up. You have to understand going into earnings cycle, the markets or the individual stocks typically start running up into that, but you probably won't really see that till like July, the first week of July, once the quarter actually ends. Do we start running it up? So we'll see if that's the case or not. But ultimately right now, again, should be a quiet next 2 weeks, and then we'll kind of go from there. But again, ultimately, we're watching headline news. We don't know when the event's going to occur. Again, they try to keep wraps on everything way ahead of time. This is why they do strategic planning. So just keep that in mind. So if there's something does happen, something major happen, and Powell starts chatting and then comes on the horn when he's not scheduled, those are the kinds of things you want to look out, because as soon as he says, yeah, we're going to have to cut rates here next Tuesday, and this is what's going to happen at that point, then you can potentially look at the bond plays at that point, depending again on the size of the cut. So that's another thing you have to take into account, is what the size of the cut's going to be. If it's greater than a 25-point basis move, again, a 25-point basis move cut is more so, in my opinion, is just a political move, and it's not more so for the dire sake of the economy, because, again, you want multiple cuts because that would essentially allude that there's a bigger problem here, a recession being priced in, then we could price in a recession. But I will say from price action that the market wants to dump, and it's being artificially held up. And I've been talking about this for a while. A lot of people anticipated a drop, and this is what you've seen over the past year, is essentially the power of the Fed and how they keep the market propped up. And again, you can't bet against the Fed. You have to wait till they're actually actions, not what they're speaking, because they give two different versions of what they think, of what they're thinking. And again, ultimately, it's going to be based off the actions. And the only way we're going to know that they're going to start cutting is our best guess is through essentially earnings cycles. Will expose a lot more of the truth, closer to the truth than what actually is being reported on a lot of these data sets. So you have to keep that in mind, because again, they go back and they revise these things down a lot, which we've seen heavily on jobs, which we've seen with core CPI. These are things that are changing. And once actually we get past this and actually price in a recession, then some point a year after that, they're going to say, yeah, so we were in a recession or a depression. I would say we're probably more in a depression at this point, because we've been doing this for longer than 6 months. People have been hurting a lot since last spring. And so from that point, you have to understand this is why we started diving again, that 4,100 level, and essentially the Fed paused, because if they would have let it go, the market would have crashed if they would have continued to increase rates. But they had to pause at that point because that was a turning point. So I think they did time that perfectly, or else we would have been at new lows and not new highs. So with that all being said, continue to watch and see what happens, and go ahead and drop a like if you made it this far. I appreciate you, and I will see you on the next one.